Over time, as life evolves, how should your life insurance coverage and policies evolve with it? I've got that scenario and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so as I'm recording this right now, Life Insurance Awareness Month, there's a month and a day for everything, but this is a good nudge to talk about something that might be uncomfortable. About half of American adults don't have life insurance, and those that do say they believe the coverage they have is inadequate. They're not confident it's the right amount of coverage. So my question is, how should your life insurance, your needs and the coverage that you have evolve over time? Or is it just, well, I have an event, I need life insurance and I go get some and that's it, If that was the case, then I don't think there'd be as many people surveyed that are unsure whether they have the right amount of coverage. I think if they or you are working with a certified financial planner and every so often, you don't like to talk about this, you don't like to talk about it, but every so often you just tune in and say, well, okay, do you have enough coverage? Here's what would happen, blah, blah, blah. Has anything changed? And just make sure that would give you a little bit more clarity and confidence, which is really what your certified financial planner should be delivering. And so a basic scenario, kind of a basic plain vanilla life scenario, how should your life insurance needs and coverages evolve over time? All right, so if we start this scenario where you're just graduating college or entering your career, do you need life insurance at that point? Well, typically, if you're single and you don't have any kids, even though you're making some money, no one else is dependent upon you financially. Now, if they are, then you've got a unique or different situation. But in this basic sort of plain vanilla scenario, you enter your career, you're making money now, so if you passed away, you wouldn't be able to make that money, but no one's financially dependent on that income that you have. And so if you own a house, your parents or someone could sell the house and pay off the mortgage, or if you have a car and there's a car loan, they could sell the car and pay off the car loan, whatever. So no one's really dependent on you financially. So even though you're young and hopefully healthy, and it might be appealing to get life insurance in place, you don't have to, no one's really financially dependent on you, so you really don't have an insurable interest. Sorry, I hesitated because it's a geeky term. But you probably don't need life insurance at that point unless you just wanted to say, hey, I'm young and healthy, I want to lock something in place right now. But typically, not married, no kids, even though you are starting your career, probably don't need life insurance. Now, when you get married, start having kids, that's typically the time. So typically when you get married, okay, if that's the order, in this base vanilla scenario, that's the time when, maybe not immediately, don't talk about it on your honeymoon. If so, that's creepy and you might want to call the cops. But in the first year or two, as you're working with your certified financial planner to say, okay, financially, we want to build our life together, and these are our goals as we can envision them right now, and these are the things that coming in our financial life. And that's a great time to work with a certified financial planner and get going on the right steps and in the right direction. Life insurance should be one of those decisions and discussions. And at that point, you're still young and I would hope healthy. So you're going to be able to get life insurance really, really cheap. Maybe you're in your late 20s, early 30s, something like that. I know people are, getting married at different ages now, but I'm going to stick with this plain vanilla scenario. And you're going to do a needs analysis with your certified financial planner, a life insurance needs analysis. And basically it's not going to be fun, but you're going to role play, and the role play is going to be something like this, so husband, if something happens to you, spouse, would you continue working? Would you, what would your lifestyle be? Would you want to sell the house? Would you want to move back home? Maybe you guys relocated, something like that. Would you want to move back home? Would, in the way you envision your life, would you have a couple of kids? Would you still, want to cover college and help with college for them, blah, blah, blah. And then vice versa, roles reverse. So, so wife, if you passed away, husband, would you continue working the same job? Would you move back home? Would you, and yeah, it's not fun. Right? And your CFP is going to kind of ease through all those emotions and sort of try to get to just the objective answers. And from there can sort of piece together this needs analysis, which determines, well, how much gap is there? How much life insurance would you need? And is that a permanent need or a temporary need? And base vanilla scenarios, probably temporary need. So you're getting a 30-year term policy. Dave Ramsey says you need a 20-year term policy. Well, listen, if you're in your late 20s, a 20-year term policy is only going to get you to your late 40s. You're still going to have a need for life insurance at that point. Locking in a 30 years while you're young and healthy, lock in that coverage for as long as possible so that price is protected, okay? So at that point, you're probably getting a 30-year life insurance policy, but that's likely not the last time you're going to need to revisit this. So life rolls along, you're married, have kids, and as you start having kids and those kids start growing, you likely need a little more space. So you probably now have a bigger house with a bigger mortgage. Maybe you've had to relocate a little bit for jobs and that resets the mortgage or, elevates and increases that mortgage. You might have some other debt as well because life's messy and gets complicated. And hopefully you've been saving up for your financial goals and sort of getting self-insured, but you might not be on saving as much as you would want. So one of you, maybe has seen some job growth and some income growth. Along with that comes lifestyle growth. So maybe originally you thought, yeah, we could live on this, or if something happened to one of us, I could live on this much income, and now it might need to be more. One of you might have had a job change where you're working less to stay home with kids, whatever. So you're going to want to tune into this plan and take a look and say, well, does the life insurance that we have, that we originally got in place, does it still fit our situation? And I'm telling you, a lot of times it doesn't. 5-10 years later, after that original policy in your late 20s or early 30s, 5-10 years later, you might realize we've got a gap. And when that happens, you don't likely scrap the old policy and just cancel it and get a new one. What you do is you'd update that life insurance needs analysis to see how much that gap is, quantify it, have that discussion with your certified financial planner, and then you likely add on a new policy. So laddering your policies. You add on a new policy that's either 30 years because you're going to get a sense, you're going to have a better sense around 40 as to whether you're going to work until 65 or whether you're on track to retire early, or, it's not going to be perfectly clear, but you'll have a vision. And at that time, you'll say, yeah, let's get a 30-year policy or a 20-year policy. And you'll keep that 30-year policy that you had in place originally because you were young and healthy. And even though you're around 40 or late 30s or early 40s, you're still pretty young, but you're not as young. And hopefully you're still really healthy, but odds are you're not as healthy. And so instead of canceling the original policy and replacing it, keep that other policy in place and just add a new policy that fills in the gap. And so I'll just throw some numbers at you. If that original 30-year policy was $1 million, and that sounded like so much way back when you were 28 or 31, you might now be adding a $500,000 policy on top of that, or another $1 million policy on top of that. So therefore, while you've got that bigger mortgage than what you thought, and lifestyle is expensive because you got the kids and college, the kids aren't through college yet, you're going to have extra coverage while those things are still in place and those aren't completed yet. But then as you kind of approach retirement, that's sort of this third stage. And as you're getting close to retirement, hopefully those kids are off the payroll, right? They've graduated college, so that expense has been covered by your income because you didn't pass away. You're able to afford getting them through college, and they're no longer dependents, and they're out on their own, and that's great. And hopefully that mortgage that grew, you've been paying it down, and while you're closer to retirement, that mortgage is either paid off or it's close, or you've been building up retirement resources also, not an or, it's an and or. You've been building up retirement resources where pretty soon you're going to be able to walk away from that paycheck and live off of your Social Security and other income sources in your investments. At that time, if you don't have any permanent life insurance need, or you're not using life insurance to help manage long-term care risk and other things, then it's possible you're self-insured at that point. And by the time you reach retirement or thereabouts, and again in this base plain vanilla scenario, you may not need life insurance. So that first term policy that you got in your late 20s or early 30s, by the time you're 60, that's matured and you're probably okay with that. And you step down and you still have that coverage that you got in place in your early 40s, but you'll keep that around until maybe you retire, and at that point you say, all right, we're going to stop paying this thing, we're going to cancel it. And you might then, once you get to retirement, say, I'm self-insured from a life insurance standpoint. And that's the case, again, plain vanilla for many people, okay? And then the final stage of life insurance needs comes maybe in your mid 70s or late 70s, and it's not really life insurance per se, but it's planning for final expenses. And when you do that, oftentimes we're taking a look with folks and say, well, you've got enough resources saved up that the final expenses are covered for because of the IRA and 401ks that you've rolled into that and all of that you've built up. But as you pre-plan in your late 70s or whatever, you might be enticed to prepay as well, those final expenses. And if you do that, essentially you're working with a funeral home, and they might not even say this, but you're actually buying a life insurance policy through them that says, I'm prepaying, I'm going to give you a chunk of money right now, and whether I pass away in 5 months, 5 years, 10 years, or whatever, there's a life insurance policy that the funeral home will receive, and that will cover the cost of providing all the arrangements that you've made. And so in a plain vanilla scenario, for many, many of us, that's the life insurance kind of evolution of what your needs are going to be with life insurance and coverage and everything throughout your life. Now, does that fit in your situation? It might, and it might not. And so if it does, still work with that certified financial planner. They've got to be doing comprehensive financial planning. Otherwise, they're not going to know how much life insurance you need. They really, really won't. They'll just be making it up, or they'll be trying to sell you something. If they do comprehensive financial planning, they're your CFP, they're going to go through that needs analysis, life insurance needs analysis process with you and help you get the right amount of coverage at the right time. And then every few years, again, not every year, certainly not every meeting, no one wants to talk about their mortality. Every couple of years, he'll tune in and say, is this still the right coverage? Let's update things and so on. And they'll be able to adapt with the times, okay? But if you're in the maybe 50% where this plain vanilla scenario doesn't work, because your financial life is as unique to you and your needs are different because you maybe have a special needs child, or maybe you've got lifelong income and you are going to need some permanent life insurance, or maybe there's some health history that's unique to you and your family you've got to protect against. That's where also you need to be working with that certified financial planner to talk through those unique circumstances and craft a life insurance strategy that's appropriate for you. All of this centers around working with a CFP that's doing comprehensive financial planning. So if you don't have one of those on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.